right, so welcome back to part 2 of our study on how you can avoid throwing money away by using Social Security arbitrage strategy. So go back to part 1 if you're just jumping in, where we showed you can make almost $250,000 by simple arbitrage. So we're going to do the 2 examples here right now that the good professors over at Stanford and that George Mason share with us. And then again, we'll go down the whiteboard below for part 3. I'll draw it out for you because again, if your brain works like mine, you got to look at it a couple times. You got to see the visual. So we'll give you the verbal and then we'll give you the visual. So don't forget to subscribe, of course, and then subscribe link. No, thumbs up, comments. All right, so the illustrative, I thought it was illustrated. Illustrative examples. We're going to give you 2. A few simplified examples will illustrate the various arbitrage opportunities we examine. Consider John, who is single and age 66, claims an annual Social Security benefit of $12,500. John also uses his retirement savings to purchase an inflation index single life retail annuity that pays him $1,000 annually, just $1,000 a year, starting immediately. The cost of this annuity is $22,290 or $22.29 per $1 of annual lifetime income, again, indexed for inflation. So all told, John pays $22,290 and enjoys $13,500 of inflation-protected lifetime income. So he puts $22,209 out and he gets $12,500 in Social Security and then $1,000 in the retail annuity. So he has $13,500. Costs him $22,290 and he gets $13,500 each and every year for the rest of his life. And that $22,290 is just a one-time thing, all right? And it's adjusted for inflation. We would argue that John has made a costly mistake. Given John's age, he has the opportunity to delay claiming Social Security. If he delays by 1 year, his Social Security benefit increases by 8%. In this case, delaying a year increases John's annual benefit from $12,500 to $13,500. Thus, after the delay period, John's income is exactly the same as it was his initial strategy. But this time, his income is solely coming from Social Security, because his Social Security benefit at 67 is $13,500. His Social Security benefit at 66 was $12,500. So if he delays and he needs $13,500, the $13,500 comes solely from Social Security. All right. During the first year, John's income is even higher, as he would have had access to that $22,290 that he would have used to invest in the annuity. By deferring Social Security, John can increase his annual real lifetime income by $1,000 for a one-time cost of $13,500. In effect, Social Security is offering to sell John an inflation-indexed annuity for $13.50 per every dollar of annual income, much lower than the retail cost. So this is where I got confused, and this is why I will say when I show you on the blackboard how this works. It took me a while to figure this out. But again, at the end of the day, in year 1, John's going to get $13,500 of income. That's what he needs. In year 1, he's going to take it from $12,500 from Social Security, and he's going to purchase a $1,000 guaranteed annual inflated annuity for $22,290. All right, so that's how he's getting his $13,500. $12,500 Social Security, $1,000 from his annuity. To get that annuity, it costs him $22,290. Now, if he delays taking Social Security and waits the following year, his whole Social Security amount will be $13,500, which covers his income needs. But this year, he didn't have any Social Security. So how much did it cost him to live? Well, he needed $13,500. And he spends $13,500 as opposed to buying the annuity, because that's what he needed. $13,500 is a whole lot less than $22,290, and that's roughly $8,000 of arbitrage savings is what he has in his pocket right there. And again, we'll go downstairs and draw that out. This example highlights 2 key points. First, deferring Social Security is equivalent to purchasing an annuity. In this case, the deferral-based annuity costs $13.50 per dollar of income. Second, since the deferral annuity is cheaper, there is a clear arbitrage. Compared to John's original strategy, the new strategy that eschews the retail annuity and purchases the Social Security annuity earns a risk-free profit of $8,970. The difference between delaying Social Security cost him $13,500 in that year, which he delayed Social Security, or taking Social Security at 66, but he still needs an extra $1,000, which costs him $22,290. Those two differences, $8,790. Note that by itself, purchasing the retail annuity is not necessarily a mistake. Moreover, claiming Social Security at 66 could be justified under certain conditions. However, the combination of purchasing an annuity and claiming Social Security at 66 is clearly a mistake, and that especially when there's an alternative strategy that does the same thing for a whole lot lower cost. The same basic argument can be applied to other situations. For example, if John is married, primary earner, then an increase into his Social Security benefit lasts for as long as either he or his spouse is alive. He could also buy this type of income boost in the retail market by purchasing an inflation index annuity with 100% joint and survivor provision, assuming his spouse is also 66. The cost of that annuity to generate $1,000 doesn't cost $22,290. In this case, because there's two lives it's covering, it costs $28,547. $28,547, which is more than double the cost of the Social Security annuity, which is $13,500. A better half off sale for the Social Security annuity. In this case, avoiding the retail annuity and purchasing the Social Security annuity earns him a risk-free gain of $15,047. Very few people purchase inflation-protected annuities. So what happens if someone purchases a nominal annuity instead? A nominal annuity is simply where it does not keep up with inflation. Well, the cost of this annuity is $15,268. Again, not keeping up with inflation, just giving $1,000 each and every year, which is still even more than the Social Security inflated annuity, which costs $13,500. It's nuts, I tell you. All right, so John is paying $15.27 per dollar of nominal income when he could have purchased the $1 of real annual income from Social Security for $13.50. It's crazy. The Social Security annuity income costs less and his cash flows are higher if there's a positive inflation, and the same if there is zero inflation or deflation. So if you don't have any inflation or any deflation, you're not losing money. You're actually still gaining money by doing the delayed strategy without an index annuity, without an index, not index annuity, inflated index annuity. But obviously there's going to be inflation. So at the end of the day, the idea of no inflation is silly. So because of that, it works every single time, every time. That's the arbitrage. Every single time you do this strategy, you'll be better off for it. The Social Security, the difference in price is $15,268 for the non-inflation index versus $13,500 represents the arbitrage in this profit in this case, which is $1,768. All right. If John were married, 100% joint and survivor annuity would cost $18,798. Again, just going back to the arbitrage opportunity for either a single person or a married person. Either way, he makes money by delaying Social Security and purchasing and not purchasing a retail annuity. And we're talking huge amounts of money. All right, so let's keep going now. To provide intuition for the arbitrage opportunity, we have focused on the benefit from a single year of deferral of conveniently sized Social Security payout of $12,500. However, in many cases, the arbitrage benefit can be quite large. To get a rough idea of the maximum arbitrage benefit, assume John is a 62-year-old primary earner and earned the maximum taxable amount each year of his career. He is entitled to a Social Security benefit of $24,000 at age 62. If John can maximize his payment from Social Security by deferring until age 70, at 70, he would receive $42,240 from Social Security, which is a $18,000 increase from if he took it at 62. John would also receive $42,240 each year during the delay period if he used $337,000 of his retirement savings. So again, here we're talking about here, he needs $24,000 a year to make up the difference because he's essentially taking Social Security at 62, or he's taking Social Security at 70. All right. So basically, Social Security is giving $24,000 at 62. Taking it at 70, he's going to get $42,240. If he needs $42,240 each and every year from 62 until 70, adjusted for inflation, he could take $337,000 out of his retirement account. So he needs $42,240, of which Social Security provides $24,000. The difference is $18,240 a year. You times that by 8 years, and you get this amount here, all right, $337,000. Instead of the Social Security deferral, John purchased an inflation-protected joint and survivor annuity that paid out $18,240 annually from USAA, TIAA, CREF, or something like that. In this case, that annuity would cost him $586,000. And again, we'll draw this on the whiteboard. It'll be easier to understand when I do this on the whiteboard. In this example, if John switches from purchasing the annuity to deferring Social Security, he would earn an immediate arbitrage profit of $248,405 risk-free. Not too shabby, my friends. Just think, but again, wait till we get to the whiteboard. We'll show you. If the spouse is considerably younger, then the gains would be even higher because the retail annuity cost would increase while delaying the Social Security remains the same. Because the retail annuity is based on 2 lives. You got John, in this case, say he's 62. And Sue, in this case, she's 58. There's a 4-year cost that the insurance company says, well, I got to cover not just John, because John's the male, he's older, he's going to die first, but I got to cover Sue. The arbitrage gains can be used to buy additional real annual income equivalent to 18% of the total annual income amount for those age 62. That's nuts. Just again, if you're looking at a joint life annuity and one person is younger than the other person, the cost to buy that joint life annuity is significantly higher than what Social Security offers. It's nuts. At 66, we showed that Social Security annuity was priced at $13.50 per $1 of annual income, and that is including inflation adjustments. It's just, man. It's crazy. All right, let's keep going down here. All right, let's see what else we got. Got other stuff here, and we'll show you some of the charts they have as well. That's why I keep looking over to the right, because I hope you all can see this. I know last time my Wi-Fi goes in and out. Got all my kids on the Wi-Fi, and it's cloudy and rainy out there, so sometimes my Wi-Fi doesn't focus very well. So I'm hoping to show you the charts, and that's why I keep going to the right to see if there's a chart that I need to be referring on the PDF. All right, so there are several interesting results observed in these graphs. First, couples have larger arbitrage gains opportunities relative to singles, again, because it's a joint life. And there are larger arbitrage gains from choosing the deferral strategy over retail annuities compared to defined benefit annuities. So I want to talk about this for just a second. And this goes back to taking a retail annuity, has nothing to do with Social Security for a second, versus buying one from your company. All right, so let's just say you have a 401k and your employer allows you to take an annuity. You can annuitize it. Or you can say, well, I'm going to roll that money over and buy a TIAA, CREF, USAA, the principal, whatever, annuity instead. What will pay more? Well, most likely your company plan will pay more. And here's why. Because a company plan is based on the general population of the people in the 401k plan. And you're going to have people who smoke who are going to die early. You're going to have people who are like you, a triathlon, marathon person who's doesn't have a high BMI. And they're going to put all these people into one group. And that group is a standard life expectancy for the one group. So they're going to say, Miss Martha over here, who's 500 pounds, smokes 2 packs of Cools a day and eats McDonald's all the day. And then you got Miss Joan over here, who's a triathlon, athlete, low BMI. They're all put together as an average. So Martha and Joan together is going to be average, Jenny, whatever. And so because of that, so what's happening here is when Martha dies, she's subsidizing Joan's annuity payout. Does that make sense? That's the mortality credits you get in a group life insurance contract, be it health insurance, life insurance. In this case, life insurance is an annuity. And so essentially what's happening is Joan is benefiting from Martha's bad health. Now, so essentially, she's getting the rates of Jenny in the middle, but she's still Joan. She's not likely to die early. When you do an individual private annuity, it's more based specifically on you. All right, so they don't throw you in the group of all people, all buyers that a company plan can. So it's not all the time, but generally speaking, if I had a choice between a retail annuity And again, we're talking income annuities or one through my employer. The one through your employer will probably pay you more, and it might even be significant. So look into that before you just blindly roll over your 401k to an IRA and then turn around and annuitize it. It might not be the best strategy for you. All right. Let's see here. So secondly, the primary earner in a couple should never choose to claim Social Security before age 70 and buy a retail annuity. Since for all ages, the area is black, it benefits you not to do this essentially. Third, even for singles, choosing to buy a retail annuity and not defer Social Security is almost always a dominated strategy, which means it's the worst strategy there is. Real retail annuities are dominated by the deferral strategy in all circumstances. I just want to say this again. The primary earner, so Josh and Charlotte, historically in our life, as a married couple, I've been the primary earner. I should never choose to claim Social Security before 70 and buy a retail annuity, ever. Since every single situation for that is better for me to defer and take the Social Security annuity every single time. And then if I'm single, choosing to buy the retail annuity and not defer Social Security is almost always a dominated strategy as well. Retail annuities, essentially the price of retail annuities versus what you get in Social Security is every single time dominated by Social Security being a less expensive annuity. It's amazing. Do I want to see anything here for a graph? Okay, yeah, retail annuities is the worst strategy. So the Social Security annuity is annuity through your company, or the retail annuities. The worst one in that case is the retail annuity. All right, so we do want to look at this. Table 2, let's see, this is page 18. So let's go to page 18. And this is post-tax analysis too, which I like because this is even before taxes. And remember, Social Security is much, much more tax-friendly than IRAs, annuities, or anything like that. So let's look at page 18, the tax implications here. Yeah, okay. Oh, yeah, this is great. All right, so we're going to look at this right here, and we're going to say, okay, table 2, post-tax analysis, real annuity versus deferral to age 66. So here's our baseline. You got we'll say Josh is the primary earner, Charlotte's the secondary. We got an annuity of $5,000 a year. We got other income of $30,000. All right, and that's going to be, anything, 401k, IRA distributions, you just name it. So our combined income, our provisional income, is going to be half our Social Security plus this other stuff right here, and that's going to be $50,000. So Social Security is $30,000 total. Half that's $15,000. We take our annuity payout, which is $5,000. That's $20,000, and we add our other income. So we have $60,000 of combined income, which makes our taxable income, taxable Social Security, $11,100. You take the federal taxable income, it's $46,100, and you're going to pay tax of about $6,000 on that. All right. So again, you take your provisional income. How much of that is taxable to Social Security? The taxable Social Security is $11,100, and that so $11,100 is your taxable Social Security plus your your other income plus your annuity income. That's $36,000. $35,000 plus the $11,100. Your taxes owed in this case are $5,933.93. Now I'm going to defer Social Security, all right? And so here I still need to make up that money. I still need this amount of money after tax income of $59,008, and I'm going to take that from taking more from my IRA and 401k. So deferring Social Security, but taking more from my IRA and 401k. So now I'm just paying. I only have taxable Social Security for my provisional income. I got an annuity payout of $1,722. I got other income, $56,000, significantly higher than before because I'm taking more from Social Security out, which means my combined income is $63,071. Again, provisional income, which means I have to pay $8,500 in taxable Social Security. It's 85% of the $10,000 that Charlotte was making. At the end of the day, I'm paying significantly more in taxes. That's almost a double, not quite above 40%, 60% increase in taxes for the same amount of money. All right. So people are like, whoa, I don't want to do that. But watch what happens now when I start taking Social Security at 66. Now my taxes are about $400 lower, but my income is significantly higher. I got $62,881 of after-tax income compared to $59,000 of after-tax income I had before. So my taxes drop, not significantly, but $400, about 8% would drop in taxes, but my income went up by that's about 5 or 6% there, simply because Social Security is tax much more friendly than anything else. So essentially, if we're paying a little bit more tax today, and from 62 to 65, I get a whole lot less in tax in the future, all the while getting more income as well. And then when I die and I leave it to my wife, so now Charlotte, she loses her benefit, but instead she gets mine. And again, we're inflating that with inflation. And you can see here, she has a 4,196 increase. We're not inflating with inflation. We're inflating this because I get 4 more years, 8% a year of my delayed earnings credits. So my Social Security benefit is higher, and which essentially gives her a significant bump over if I did not delay, which is $4,196. So she pays $1,000 less in taxes and gets $4,200 more in income simply because of deferring Social Security. And again, I've talked about it a million times a Sunday on my YouTube channel. I just can't stress enough the after-tax ramifications on deferring Social Security as well. So let's keep going down here. I think I only got a couple more things I want to talk about before I get on the whiteboard here. So let's see what we got here. It's the taxation implications of the alternative strategy depend on the amount of the other income the household receives. That's your combined income. So it really depends on if your IRA distributions, if you don't have any other income. But just remember, you're taxed much, much more heavily. Well, I think we talked about that here. I think we do go into that here a little bit right here. The pattern is okay. So it depends on your other kind of income in terms of why is more beneficial to defer taking Social Security from an after-tax perspective. More income, less taxes, the higher the Social Security payout is. This pattern is primarily caused by Social Security taxation rules. At low income levels, Social Security is not taxable income. At high income levels, 85% of Social Security is treated as taxable income. This transition creates anomalously high marginal tax rates that the alternative strategy helps avoid, which is alternative taking Social Security later. For example, suppose a household is in a 30% tax bracket and then receives a marginal $1 in extra income. The tax on this $1 would be normally 30 cents. In a $30% tax bracket, you get an extra dollar of income, the tax is 30 cents. However, an extra $1 in income would also cause up to 85 cents of your Social Security to transition from non-tax to taxable. This $1 in additional income would then create a total tax increase of 55 cents. 30 cents for the normal tax bracket on that dollar, and an additional 25 cents in tax due to higher Social Security taxable income. The marginal tax rate for that extra dollar is 55.5%. In this income region, the alternative strategy converts highly taxed annuity income into more lightly taxed Social Security. Who's ever talked about that before? Has we ever heard this? Oh, your old buddy Josh. At sufficiently high income, Social Security is maximally taxed anyway, so the benefit peak dissipates into a plateau. So basically, if you're in the 12% tax bracket, 10% tax bracket, this is deferral strategy benefits you more significantly than it does once you're in the 22%. Without question. It's nuts. The whole tax thing on Social Security is crazy. All right. Our after-tax results corroborate the pre-tax analysis. Namely, there's a large and ubiquitous arbitrage opportunity when a real annuity is purchased and a smaller but widely available arbitrage when a nominal annuity is purchased. When a defined benefit cashed out is considered, married couples generally have an arbitrage opportunity. For singles, there likely is not an arbitrage, although they are still likely to be better off cashing out their defined benefit plans to defer Social Security. Given the consistency with which the after-tax results track the pre-tax results and the fact that alternative strategy often conveys tax advantages, we believe that the arbitrage results are generally robust to after-tax considerations as well. The results in this section are also consistent with a couple other people who document this in terms of replacing IRA income with Social Security income through delaying Social Security. So that's pretty much all I want to talk about this here today. I just talked about the after-tax consequence of Social Security and how you can benefit from that as well. On top about the arbitrage of taking deferring Social Security and taking as opposed to taking a retail annuity. And I think we're a conclusion. Economists are hesitant to call observed consumer behaviors mistakes, as different preferences can justify lots of different behaviors. However, by focusing on cases that are more clear-cut, we have shown that it's possible for retirees to make big mistakes with their choices regarding annuitization of retirement resource and the claiming of Social Security. Many Americans retirees have an arbitrage opportunity of effectively selling a more expensive life annuity, a retail annuity, and exchanging it for equivalent or superior life annuity through Social Security that's cheaper. Up to 25% of retirees may be receiving income from both Social Security and private annuities in their mid-60s. These individuals and their employers, if they do not offer a lump sum option, are collectively foregoing arbitrage opportunities. The arbitrage gains are around $100,000 for married primary earners with average earnings and can reach about $250,000 for those with high earnings. Taking Social Security early and annuitizing income waste this money. While taxes complicate the argument, our general findings are robust to the inclusion of taxes. All right, so let's go down to part 3 when I go down the whiteboard. So hang in there. Don't forget to subscribe. Comments, thumbs up are welcome. And we'll go on the whiteboard and I'll draw this out for you. We'll see you here in just a second. Thanks, guys.